Hello friends, this is Vijay Bhambwani. I trade for a living and I've been doing this for 35 years, 28 of which are spent as a founder, promoter and CEO of an incorporated limited company that trades for a living. In my videos, I would like to help my viewers become better traders, better thinkers and intelligent investors and traders who basically know what they are doing and know which direction they are taking in the market so that they are on a better footing as compared to the broader markets and their contemporaries and other market participants. So in this video, I want to touch upon the aspect of FII investments. Why do FIIs or foreign institutional investors invest in India? Are there more than one reasons, and do you know these reasons so that you can gauge how long they can continue to invest in India? And when is it then they would preferably prefer or we fear might pull out money out of the country? You know what? FIIs own approximately 1/4 of all the equities in the Indian bourses, and therefore their actions can actually sway the market significantly, impact sentiments and definitely impact stock and index levels. So we must know why they do what they do so that we can actually gauge what they will do next. Now, the thing is, burning question, trillion-dollar question, zillion-dollar question, why do FIIs invest in the country? What reasons? The number one reason is because we are a great market. No denying the fact that we have been basically defying gravity where our financial markets are concerned. Markets have been zooming, there's profits to be made, and if at all you want to be an emerging market investor, what's wrong with India? We are leading the pile here. So, no questions about that. But that is the most obvious reason. Are there more reasons? Definitely, yes, and you should know them all. Number one, because of the cash carry trade. Now I come back to bond yields. It's a subject that some of my trolls don't like because they don't understand it. And therefore they would not like to hear about it. But FII flows depend on this. Supposing there is a country X that gives 1% interest on deposits. And here is India, which offers 6% on deposits. It actually makes sense to borrow from this country, which is lending you money at 1%, take the money through the banking system, invest in India at 6% and earn the arbitrage, which is 5% gross. Of course, there are charges like remitting charges, etc., but we'll get to that. So there is a gross differential of 5% which you can make clearly. Of course, to hedge the bet against currency fluctuation, you would spend some more money in hedging, which is taking a bet on the USD INR. The second aspect, and why in my weekly videos I touch upon bond yields, inflation, and the USD INR or the dollar levels. Now, if the rupee is stable, the FIIs find a lot more comfort in investing in India or any emerging market for that matter. Supposing the FIIs had to invest $1 in India, and when they bring $1 in India, the USD INR is at 60 rupees. So they come to the bank, they go to the bank rather, and deposit $1 and they are credited with 60 rupees in their account. If they invest this money in the stock market and buy a stock worth 60 rupees and that stock goes to 100, they would have made a profit of 40 rupees. Assuming that the rupee remains stable at 60, they will pay the 60 rupees to the bank and buy dollars and take the money back home. So very clearly, they've made 40 rupees profit on a 60 rupee investment. All fair. That's a return of almost 66.66%. So that's good. But what if they were to bring money, say $1, when the rupee was at 60 against the dollar? They made some profits in the stock market, but unfortunately when they sell these shares and the rupee has depreciated against the dollar and gone to 70. They would now have to pay 70 rupees to buy each dollar to remit the money back home. So profits from the stock market investments would have been eroded by the currency. So FIIs will not like to invest in the country if they feel that the rupee is kind of getting shaky against the dollar. So during times of currency being weak or nervous, you will notice that FIIs do not bring in money. As a matter of fact, they might even pull money out. And the recent turbulence in the USD INR a fortnight ago should have told you that when a huge spike in the USD INR took place, it would have unnerved more than one FII fund manager. This is not to say that the USD INR will continue to rise. It could be a freak one-off event, but remain assured this move was big enough to have been a deterrence to the smaller hands out there, the weaker hands out there. The third thing that FIIs would look at is inflation, which is why I cover inflation so proactively and without fail in my weekly market outlook videos. If inflation is going to rise, the rupee's buying power will erode and it will become cheaper against the USD. And therefore, the FIIs would lose on the currency aspect of their investment process. So the facts that FIIs will look at is the interest rates. As long as Indian interest rates are higher than the country from where they are getting the money, they are happy to invest. Number two, the currency peg or the value of the Indian rupees versus the dollar or euro, depending on where they are getting the money from. And thirdly, inflation. Of course, there are a whole lot of other factors like corporate earnings, etc. But these three factors you must know. Which is why I'd like to empower my viewers by including these factors into my weekly market outlook video, even though some of you might find these things a little new or maybe therefore might even resist the idea of learning something new. But hey, it's your call. And if the FIIs feel that inflation is going to rise, since the bond yields in India are rising from 5.9 to 5.95 of a band in the recent past, we've now reached 6.3, 6.35, almost kissing 6.4 at the time of recording this video. There is an expectation that inflation will rise. And CPI, as a matter of fact, has risen to 5.03%, and therefore this is a slight alarm for the FIIs. Now what happens? Why am I always talking about bond yields both internationally and in India on my social media pages? If bond yields are rising in the US and if there is a case for interest rates rising in the US, remember the cash carry trade. Taking money from a place where interest rates are lower and bringing it to India where interest rates are higher, the arbitrage or the difference will shrink. In which case, either the money which is coming from abroad into India will slow down a bit, or the Indian government will have to raise interest rates to be able to make the cash carry trade, which means carrying money from a low yielding economy to India, which is a higher yielding, interest yielding economy. So to be able to manage to keep the arbitrage lucrative, the government might have to raise interest rates. Now, when you raise interest rates, the cost of money goes up, the cost of doing business goes up, including investments, trading, and speculation. This is something that the markets know. Hey, you got to know it too. You may not like the idea of learning about bond yields and cash carry trade, etc., but whether you like it or not, these aspects are going to impact your trades and your investment. So you owe it to yourself to know what's happening in the market. This is why you should be monitoring these three aspects with hawk eyes. Inflation, currency peg, bond yields, both international and India. Friends, If you liked this video, if you found it helpful and enlightening, do click on the like button, subscribe to my YouTube channel. If you haven't already done so, click on the bell icon so you receive instant alerts about new videos being put up out here. Keep the lines of communication open. Comments, positive, negative, feedback, always welcome. And help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. Have a very, very profitable day. Vijay Bhambwani signing off for now. Thank you for watching. Take care. Bye-bye.